answer most of your questions. So who we have today, Ana Ramos here today. Ana, you want to take a minute and talk about yourself, please? Just press that button.
Hi, how are you? I don't know if I need a mic anyways.
Good.
My name is Ana Ramos. I'm with Arbor Commercial. We are a multifamily lender. A multifamily lender is anything 5 units or more. We've been doing this for a very, very long time. I have about 18 years in the business, been doing agency pretty much all my life. It's a great product to have. Should I talk a little bit about the product or, okay, in general?
Sure.
Basically, for Fannie Mae and Freddie Mac, as most of you know, there's the single-family side. Well, there's also on the apartment side, completely separate, but there's a lot of advantages for multifamily investors and also for brokers who are selling apartments or refinancing. For you as prospects or bringing deals to us, you actually get paid a rebate, which is very common in our industry, which is you get paid at closing by the borrower, but you also get something in the interest rate, which is very lucrative, and that's how a lot of brokers typically pursue most of the apartment multifamily world. So basically in our world, we have anywhere from 5 to 30-year terms. We have interest only. We have an array of prepays, whether it's step down, whether it's yield maintenance, or defeasance, if anybody's interested in that, but typically not. So our loan amounts usually start anywhere from $1 million, and we don't have a maximum. We do go below $1 million if it's more on the Fannie Mae side, but we typically like to be at $1 million or above. Interest rates are really low right now. I don't know if you follow a lot of the multifamily, but interest rates can be as low as 2.9 all the way into 5s if you're doing like a 30-year term with a 30-year AM. So it's, again, Freddie Mac just came out October of last year with a brand new product that competes with Fannie Mae Small Loan World. Small Loan World is for a typical small borrower that doesn't need a lawyer, doesn't have to have 1,000 units, a lot of property. So it's designed for that mom and pop sort of borrower, which is a very good product. And that's where you're going to see rates in the high 2s, which is really, really attractive. Right now, if you talk to most lenders, and especially with this license, which is for the Freddie Mac, we are bombarded with business. So it's a good problem to have, so we're not complaining. We know it's not always forever, but the interest rates are very, very attractive at this time. So I encourage you to go out and pursue apartments as much as you can, because it is very profitable for you as well. Again, you get paid at closing by the borrower, the origination fee is yours, but you also get a back end, if you choose to, that's built into the rate, which is completely acceptable. It's not unethical. It's very common in our industry, especially when we're doing wholesale and dealing with brokers or realtors, usually by referrals and things like that.
All right.
Thank you.
Oh, question?
I have a question. With Fannie Mae Freddie Mac guidelines, if a borrower has 5 mortgage loans, they are not a candidate for a mortgage. But in your world, as you call it, is that a criteria as well?
What do you mean 5 mortgages? I don't follow.
If you own 5 properties,
Yeah.
residential, this is the
Yeah.
Fannie Mae Freddie Mac.
Oh, okay.
But in your world, is that
That's great that they own other assets. Is that the question?
5
Yeah.
is a maximum they are able to get a loan with the Fannie Mae Freddie Mac guideline. Is that an obstacle in the commercial side?
I guess I don't understand the question.
How many properties they allowed to have? That's what he says. How many properties they allowed to have?
Oh, they can. We want as much as possible. If they own a lot of, as long as their net worth is equal to the loan amount, as long as their liquidity meets the requirement, which is typically 9 months of principal and interest payments for the loan, we don't necessarily care what else they own, as long as they're solvent. I mean, they can't own 1,000 properties, and you look at their real estate schedule, and it's a negative cash flow. So obviously we underwrite and we look at that. We don't do a global cash flow like banks do, but we do look at their overall. But for example, if they own single family and they live in it, well, there's no income coming in that. So obviously you're in the hole there, right? It's negative. So we take that into consideration. But we look at his whole financials. But the more experience you have, the more exposure of things that you own, it's actually a plus. It's not necessarily a negative, as long as it's not, drawing your cash flow and it's, sinking you, and it's getting worse in terms of your financial wherewithal.
Thank you.
Okay.
All right. So next we have Lee O'Donnell here, and Lee is going to talk about the commercial building. So I'll let Lee take it for a minute. please.
Good morning. I'm with EH National Bank. My name's Lee O'Donnell. I've been in the business unfortunately, since the mid-'80s. And I like what I'm doing. Loans, commercial loans has been my thing, apartment buildings. But EH National Bank, what we specialize in is probably small balance commercial loans. Retail, office buildings, mixed use, single tenant commercial. And we also will do small loan amounts, as low as $200,000. Many banks out there won't look at a loan less than $1 million or $750 or $500. We'll do loans $200,000, $300,000, $400,000 for commercial, up to $4.5 million. We're a portfolio bank, which means we do not have to pre-sell our loan to close it. It's our own money. And we're also a small bank, and the good news of that is I only have to deal with 2 decision makers on my loans. So that's kind of a plus. And as far as, am I looking at questions from them as far as how much down payment, interest rates, and so forth?
We'll get to those.
Okay.
I'll come up.
Gotcha.
Okay. All right. And then finally, we have Benjamin Stoll Walsh here from Wells Fargo. Ben, please.
Thanks, Mo. Good morning, everybody. See a lot of familiar faces. We did a mixer about a month ago with Mo. Thanks again for joining us. So I handle SBA lending for Wells Fargo. I've been in the business for about 15 years, district sales manager for Wells Fargo's Los Angeles region. What is SBA? We'll get into a lot of those questions as we're working through Mo's Q&A here. But this is owner-occupied commercial real estate. And again, what owner-occupied means is you've got a business owner that owns their own business. They're going to be putting their business into this property that they're going to be purchasing. I think some of the key fundamentals, 51% occupancy, qualifies for the platform. And it could be any array of different types of businesses that could fit this particular program. So we'll cover a lot of these questions in the Q&A, and encourage you guys to ask questions while we're working through them. Thanks for having us.
Excellent. So we'll go back to Anna. Anna, do me a favor. Take a couple of minutes to talk about interest-only loans. How do they work out, and what are they looking for if these guys are talking to their investors?
Interest-only loans, with Fannie Mae, there's a little, sorry.
Thanks.
Hi. We'll start with Freddie Mac. With Freddie Mac's new product, interest only comes with what's really attractive about that product is that they created a 5, 7, and 10. Whether you want it fixed, which is a balloon, or whether you want it hybrid, which is fixed and then it rolls into an adjustable. But what's great about that product is that when it came out and it launched, it comes with interest only. There's no added fee. It automatically comes with it. Believe it or not, there are some borrowers that do ask that we withdraw the interest only because they're conservative borrowers. So if you're looking for a 5-year, it comes with 1 year interest only. So there's no set parameters. It just comes with it. You don't have to meet a certain debt coverage ratio or a certain LTV. If you're doing a 7-year, it comes with 2 years. And if you're doing a 10-year, it comes with 3 years. The great thing about interest only, and especially in the agency world, is that once it resets, it's with a 30-year AM. So in year 3, after you're done with your interest only, your amortization is reset to 30 years. It doesn't go to 27. So it's a really good thing, and borrowers really like it. If you want full interest only, that's also another option, but you have to be at a 140 debt coverage ratio and no more than 65% LTV, and it does cost a little bit more in the interest rate. But that advantage is pretty much right now what a lot of borrowers are taking. A lot of deals out there are definitely cash flowing, so they have that advantage that they're able to do that.
Excellent. Thank you. So, Lee, I love that first one. We're talking to our investors, and the first question to us is, well, how much money do I need? So how much money do I need to get a loan?
Well, with banks, it's a little different than SBA. The SBA can do leverage, 80, 90% and all that. With banks that look at loan-to-value guidelines and debt coverage ratios, and with the rates being in the low 4, mid 4-ish, buyers will need between 25 to 40% down. And the range is that wide depending on what the cap rate is on the property that someone's buying. This is investor property that's cap rate driven for value. So the banks, us, like all banks, we're going to underwrite the cash flow with our debt coverage and qualify for the loan. Something in a very high-end area, like maybe something nice on the Esplanade that's going to have a low cap rate, that kind of deal, the buyer is going to need a lot more down, 35, 40% down for a commercial deal. Versus let's take something way out in the middle of the valley, it might be a 25, 30% down deal. So there is that wide a range, so what you want to do is send information on the property so I can do the math quickly so you know what to tell your people.
Excellent, thank you. Now, the same question to Ben. Yours parameters are a little different for SBA.
Good segue, Mo. Yeah, so SBA, again, the key thing is it's not investor real estate. So, again, you're looking at circumstances where you've got an owner of a business that's going to purchase this real estate. The difference between what we'd be looking at on a commercial loan with an individual that wants to buy it and use conventional financing is, as Lee had mentioned, it's typically 25+% down. With SBA, you can get in with as little as 10% down for the right types of property. So what would typically qualify for that? Typical office space, light industrial, warehouse, those are all going to be 90% financing, assuming the borrower can qualify for it. If it's a special purpose property, a gas station, a hotel, a car wash, a restaurant, you can expect that those injections are going to go up. So the leverage would go from as little as 10% down to, on those single purpose properties, probably looking at more like 15+% down.
Excellent. So going back to Anna, do me a favor. From time to time, people are asking us, this is a non-recourse loan, and we're all kind of looking at them like, I have to go look that one up. So tell us about non-recourse loans, please.
Sure. Non-recourse loan is basically if the loan defaults, it doesn't personally come back to you. So that's something that's very common in our multifamily world. The number one question, well, one of the number one questions that I always get from brokers that the borrower is asking, well, is it recourse? Am I personally liable? And typically, Freddie Mac's loans with this new product, all loans are non-recourse. With Fannie Mae, loans are typically non-recourse unless you start going to, because we are a nationwide lender, so if you start going to other markets, tertiary markets, and you want full leverage, meaning 75, 80%, in order to maybe not get impounds, we offer recourse. So, but typically for the most part, they are non-recourse, which is you're not personally liable if something goes wrong. Now, there are bad boy carve-outs, so you commit fraud, you do something like that, they will go after you, but not personally liable because, major earthquake happened and it shattered the part, things like that.
Okay. Thank you. Lee, would you take a minute and talk about how do you qualify? We all have investors that all want to do something, but most of the time they don't have any money. So we're not asking the right questions. How do you qualify? What do you need to qualify the borrower, please?
In a perfect world,
Perfect world.
email tax returns and a list of the properties they own. Start with that right away to see what the tax returns show,
Okay.
their personal income. Then the sidebar is the property. Send all the information you have on the property. It might be a broker marketing package. It might be that the seller has an old appraisal and he's got a current rent roll with his management company printing out their operating statements. So as far as the property, you always want to have a rent roll or lease summary, we call it in commercial. It's a list of the tenants, when they moved in, when their lease expires. This is very important for commercial to have a lease summary that shows who the tenant is, maybe a sidebar on what profile, what that tenant does, because they're going to ask and want to know, when they moved in, when their lease expired, etc., and per square foot. With commercial, everybody's looking for the per square foot. What's the square feet of the space of this tenant, that tenant, the building, etc. So get what you can on the property, and then get what you can from the buyer with his tax returns, and then us, the bank, we're going to look at what the tax returns show, what their list of properties they own, what they say they make, and try to fill in and see how we're going to have to underwrite them. And there's a bit of work there.
Absolutely. Thanks, Lee. So going back to Ben, if you recall a few minutes earlier, he said for an SBA, you got to own 51% of it. So let's talk about, so I have to occupy the property to do this, but let's talk about the phase one you mentioned and the appraisal. Do I order my own, or how do we do that, please?
Good question, Mo. So the SBA program is a government-backed program, similar to what you'd see on the Freddie or Fannie programs, in that the banks have to abide by certain regulations that the government sets forth. Two of the regulations that the banks have to look at is we have to have a commercial appraisal ordered as well as a phase one environmental. What we look at as far as how to qualify those, appraisals have to be bank ordered. So if you've got a client you're working with that wants to try and get an idea of what the value is, they're going to probably have to go out and look to you for your expertise or look at some comps in the area to see what it could potentially appraise for from a price per square foot valuation. What the bank will do during the process, and it's really going to be up to your client on when they want to do this, we can order that appraisal early while we're underwriting them, or we can wait till they're approved for the financing and then order the appraisal. But the key thing is that appraisal is one item that will be needed in order to close. When it comes to phase one, and let me, I guess, explain what a phase one is. Phase one is an environmental study on the property. It's basically ensuring to the borrower as well as to the bank that there's no contamination on site. So what we'll do in these instances, the bank has a little bit more discretion on how we can handle that. We will allow your borrower to go out and order their own if they would like, or you guys could talk with the lender and have the lender recommend firms that can perform this. But again, that would be another element that would be required to close escrow. So the three primary elements that your customer, that you guys as well acting as their agent should be trying to work towards would be getting them approved for the financing, because obviously they're going to need that money to close. Getting the appraisal performed so we can ensure that the property appraises for the amount they're buying the property for. And then having that phase one environmental study done so we can ensure there's no contamination on site.
With the phase one, what if, say, the seller had a phase one study, but it's maybe 6 months old or whatever? Is there a certain, it has to be current within a certain period of time?
Great question. So a lot of times you'll be looking at instances where the seller is an individual that may have secured financing and had an environmental study performed when they purchased the property. Phase one environmentals with Wells Fargo are good for 6 months. So if that report is greater than 6 months old, what we'll typically recommend to your client is let's talk to the same vendor that performed the last one to see if we can get a discount and simply have them update that report. Because the likelihood of things changing, as long as it's not a company or customer that's on site that has solvents that could be hazardous or has materials that could create an environmental concern, more likely than not, that vendor is going to go out and perform the same work they did the first time and should be able to do so at a discount. But very good question. Yep.
I have heard that during that phase one study, there may be a retail clothing store on the premises, and they look at the chain of history behind the ownership of the property they use, and there could have been a gas station there maybe 75 years ago, and that could possibly create a problem.
Another great question. Yeah, so the whole purpose of having this environmental performed is to determine if there is concern for environmental contamination. So what the vendor will do is they'll go out, they'll perform a record search on who the tenants were for that property. If at some point in time there was a gas station or maybe a dry cleaner, something that could have potentially caused concern, what they'll do is they'll go back and we'll ask the seller if they ever had what's called a phase two study performed. And that means actually a little bit more intrusive study where they're going to go in and actually perform environmental due diligence, drill into the soil, go down to the water table. If none of that was performed, the likelihood is that the bank or the SBA is going to request that additional testing is performed. So that would entail potentially drilling, potentially going down and getting soil samples to ensure that there is no contamination. If you get to that point, it's a conversation we probably have between buyer and seller, because it starts becoming a little bit more costly. A typical phase one is going to run $1,800 to $2,100. When you get into phase two, the scope of work will really drive what the cost is going to be, but you could start talking about numbers in the, the 5 to 15 to 30,000, depending upon how much work has to be performed. So if we get to that point, that's when we'd all have a conversation of, let's talk about what the cost will be, maybe get some scopes of work from a few different vendors, determine what the cost will be, and then determine who's going to wind up bearing the burden.
Excellent. Yes, sir.
It would be a better question for a title rep, but that's our understanding, yes. Is anyone that on there could have some type of indemnification to it.
So if it's discovered down the road and you're on title and you have deep pockets, they can come after you.
Potentially.
All right. So going back to Anna, Anna does a lot of 5+ units. So I want to ask her, talk about the difference between the 1 through 4 that you're doing for 5+. What are your requirements? What do you need?
Well, I just have a quick question. By a show of hands, who has closed an apartment building in this office? Okay, perfect. My suggestion would be if you have no experience but you're really interested, you know it's lucrative, you know it's exciting, because you're not just underwriting the borrower, which is getting the financial wherewithal of the person we're lending to, but you're also getting the property financials. If it's your first time and you're not too familiar, typically, we do a lot of hand-holding, which we just need operating history, which is the typical standard, balance sheet operating statements for the property, which is the most recent, which would be 2014 and year to date, and a current rent roll. Once you provide that, we're able to run the numbers in terms of figuring out what the maximum loan would be, what we're able to offer, and the terms, understanding what your borrower needs. Every borrower has, obviously they want everything, but they can't always get everything. So you really have to understand your borrower. What is it that really is going to win this deal for you? Is it interest only? Is it the recourse? Is it the loan amount? Is it the rate? What is it that is going to win the deal? I know now this 5-year product that we are offering, we are very competitive with Chase, which in history, that's never been the case. But right now I am seeing a lot of Chase borrowers. So that's where our volume has definitely multiplied, because we're seeing a lot of that because of the rate. We have a hybrid, which is, it fixes and then it rolls into an adjustable, which is very competitive with Chase, and that's why we're seeing a lot of that. So basically that's all we typically need. And then once we size a deal, we send you sort of a couple of questions. What are you looking for? Loan amount. We go from there. Who manages? What's the cash out for? Typical questions that we're going to ask. If everything lines up, we issue a letter of interest. But in sponsors, in terms of borrowers, in general, what we require, the requirements are not that stringent. It's their net worth has to be equal to the loan amount. So if you're asking for $1 million loan, their net worth has to be equal to $1 million or more. Their FICO, their minimum score needs to be 650. And liquidity requirements, meaning cash in the bank, not a 401, not life insurance policy, but cash in the bank, securities. Typically it's 9 months of P&I, which is principal and interest payments of the current loan we're going to give them. I always just say, just make sure there's a year of reserves in the bank and you'll be fine. But that's pretty much it. Some borrowers don't have any experience, but they've owned this one property for like 10 years. So that's perfectly fine. Typically we want to see investors with, 2 or more. That's the ideal, but like I said, there's times where they don't own any. Now, if you bring a guy that says, he just inherited $1 million, never owned multifamily, and is going to start investing, that's not a turn down immediately. That just means we're going to require third-party management because he doesn't really know how to manage apartments. So in that example, we would say it's great, probably a little lower leverage. He's going to have third-party management, and he's going to grow. And we're going to help him grow through that by lending to him. But it'll also be wise lending, not just to him, but we're going to qualify the management company that he's going to hire.
All right. Thank you, Anna. So going back to Lee, a two-part question. So let's talk about how much money do I need up front, and what about closing costs? So what do I need to bring to the table, please?
A lot. Basically, just upfront is enough money to pay for an appraisal and an environmental report. And appraisals will be anywhere from $2,500 to maybe $4,000. And a commercial small version environmental report is about $900. So deals I do, the deposits up front, $3,500 to $6,500. It's all that range. So obviously, if you have a big property, it's going to cost more for the appraisal. As far as closing costs, for all the loan docs, processing, miscellaneous, maybe $500-600.
Excellent. Going back to Ben, so let's talk about, and we hear this a lot lately, talk about personal guarantees. Yep. What do they mean? What is it that when you say I need a personal guarantee?
So Anna did a good job of covering this earlier. So this goes back to the word recourse. Some of the financing she can provide doesn't require recourse, but personal guarantee would mean recourse in the SBA world. So what we're going to look at is anytime you've got a borrower looking to secure an SBA government-backed loan, they do require personal guarantees so that you are held personally responsible for repaying the debt for any 20% or greater owner of that company. So I think one common question we get is, what if I want to buy a property that my business is going to occupy, but I want to use an LLC to take ownership on title? So what the government's going to look at is we're going to say, no problem, you'll create a lease between your newly formed property holding company and your operating company, but we're going to look towards personal guarantees from each 20% or greater owner on both of those different entities. So again, personal guarantee just means that those individuals are being held personally responsible for repaying the debt. We'll look at the business as the primary source of repayment, but if there was a default situation, that could fall back on the individual. Yep.
So are you also, besides the company, are you also underwriting the individual? And then in what cases would you require a cross-collateralization?
Great question. So when we are looking at these opportunities, we're doing global underwriting, meaning that we're going to look at the business first, and that is an SBA rule that we determine that the business has the wherewithal to repay the debt. But a lot of times you'll see a business that pays the owner a salary. So some of that obviously flows through to the individual. So we are going to look at both, individual and business. If the business and the salary that the individual are taking out of the business aren't enough to cover the repayment, then we probably have to talk about projections or maybe a different form of financing. Jumping to the second question, which I think was relating to,
Well, in what cases would you require that the cross-collateral?
Cross-collateral, yeah, good question. So there's two different programs that the SBA offers. One's called the 504 for real estate. It's a two-mortgage loan. So in this instance, Wells Fargo would finance 50% of the purchase price. So on $1 million purchase, Wells would finance $500,000. The government actually finances the second, so roughly 40% of the purchase. So again, using $1 million, Wells Fargo $500,000, CDC or SBA $400,000, borrower coming in with 10%. In those circumstances on the 504 program, there typically are no cross-collateral requirements. There's another program which is called the 7A program, which is a single loan. In this instance, let's say it's Wells Fargo. On $1 million purchase, we would finance up to $900,000 of the purchase price. The government only allows us to actually consider 85% of appraised value. So if the property appraises for $1 million, they're borrowing $900,000. We'd have a $50,000 shortfall, because the government would only allow us to consider $850,000. So that could be a circumstance where we either ask the borrower to put slightly more money into the project, or we could potentially look at other assets such as equity in a home and putting a second or a third to cover that cross-collateral piece. Where we see more of this would be circumstances where you've got a borrower coming to the bank to borrow not necessarily for real estate, but maybe they're coming to us to borrow working capital for their company because they need money to cover payroll, to cover overhead costs. There isn't obviously any collateral built into that, so that's where collateral would come in, where we're looking at personal assets such as real estate or securities to cover that shortfall. The government just tells us as the lender that we're required to try to fully collateralize the loan to the extent possible. So most instances on real estate, we're not going to run into that circumstance. But when you start getting into the other opportunities, because you are working with business owners, maybe they want to buy equipment, maybe they want to buy a business, maybe they want to start up a new business, those are circumstances where the cross-collateral becomes more critical.
Yes, ma'am.
You said 85% of the appraised value is the maximum that can be funded. Would you, again, repeat what the percentage of the SBA loan and the government loan?
Absolutely. Yeah, good question. So again, let's talk loan to value versus collateral advance rate. So the government will allow us to finance up to 90% on those types of properties. So it still could be $900,000, but the collateral advance rate that the government allows us is only 85%. So what that means is if we're looking at that $1 million purchase price, we can still give them a $900,000 loan, but the government's only going to recognize $850,000. So that would be a circumstance where if they put as little as 10% down, we'd have a $50,000 shortfall, or 5%. Does that answer that question? Do you understand that? Or?
Well, you were saying earlier that the SBA loan component would be, was it 50% maximum?
Yeah, good question. So there are two programs. So on that 504 program where you've got two lending institutions, Wells Fargo and the CDC, the government's only really backing or supporting 40% of the total debt. So in that circumstance, you don't necessarily have to get to that 85% threshold because the government's only taking a 40% position. On the 7A loan program, you've got one lender, Wells Fargo, covering the full 90% of the financing. So that's where that potential 5% shortfall could come into play because the government's involved with more of the debt because they're actually backing the Wells Fargo loan.
All right. Let's go back to Anna. In the beginning, she mentioned something about rebates. I want to give her a chance to talk about what exactly is a rebate because that's a saving for your client. So talk a couple minutes about the rebate programs.
Well, rebate is more, who wants to make money? Brokers always want to make as much as they can. So the rebate is not so much of a saving. So people call it different things. A rebate is the same as yield spread or YSP, and that just means when you are sizing up a deal, whether you have to pay your cousin, whether you have to pay a friend because of a referral, so you have to build in a little bit more. So the origination fee is typically goes to you and it's paid through escrow and the borrower pays that. Typically it's 1%. Okay. But then you say, Anna, can you build up the rate a little bit and give me a half back in the rate, in the rebate, and we pay you through the rate at closing. So that's where most in the apartment world, again, it's completely ethical, completely legal. It's something when we rate lock transactions, the borrower knows that we're trading it at a premium. We don't specifically disclose or entail where it all goes, but it is allowed, and it's very common in our world. So if you're doing apartments and you have to pay a referral, you have to do this, or you're going to be working night and day for this borrower, sometimes 1% doesn't justify, and again, it's very common. I would say that 80% of my deals always include a rebate YSP, which is for the broker, not necessarily for the borrower.
You said that doesn't get disclosed on the closing statement?
It doesn't say, hey, Sam got a rebate on the rate from you. No, it doesn't say that.
Right, but
Yeah.
it does it show the fee amount, or just the interest rate's higher? And
The interest rate is higher and it's set. You send me a W-9 and your demand, and we pay you at closing because we built it into the rate. When he signed the commitment, it's because the way we're wholesale, so the way we get paid is through premium. When I quote you a rate, it's a rate that already includes that I'm going to get paid through the rate. So the borrower is based on the commitment, what we issue and what we disclose. He's buying this rate at a premium. So now what we choose to do with the premium, and that's when you give me a W-9 and your demand. Your demand from the borrower because typically, or I would advise you, whenever you're doing apartment deals, always get a fee agreement with your client, between you and your client. Don't start, my recommendation, don't want to tell you how to do your business, but typically brokers always get a fee agreement. So if you're working for a borrower who has apartments, you're going to be doing all the work for them, get a fee agreement between you and the client. So that way when that deal closes, he knows that at closing, he agreed to pay you 3/4, a point, whatever that fee is. And that's between you and the client. You put your demand through escrow and it gets paid. Okay? Any questions?
Are there certain standard fee agreements?
Typically, it's 1%. If you want to win business, I don't. If it's richer than that in our world, the multifamily world, you're not going to win business. And the larger the loan amount, the smaller your fee gets, and that's amongst all of us. So, if you want to be competitive, don't start charging somebody in the apartment world. Again, I want to separate that because I don't know single family. In the apartment world, over 1%, you're not going to win business.
All right. So going back to Lee, let's talk about the pre-approval process and the LOI, please.
Okay. Basically, the process to start a loan or pre-qualify a loan is I get information either from the realtor, or I also deal with many mortgage brokers. I get the financials, whatever they may have on the borrower. It might be a 1003 loan application with a schedule of real estate. It might be a copy package on a loan they closed 6 months ago that's still pretty reasonably accurate. I get whatever they have on the borrower and the property, and then I do my pre-underwriting and kind of spot check what I see on tax returns, what I see on their personal housing debts. And I do my own little internal debt coverage ratio analysis on the subject property, and also a personal ratio on them personally, just to get a little feel on what the deal looks like. Then I do a write-up. I present it to the president of the bank and the senior credit officer. They give me the green light. I email a letter of interest, LOI we call it. And basically a letter of interest is probably as strong as language as you get for pre-approval in commercial. And the borrower signs the LOI. They can wire in their LOI deposit. And then the loan is officially in process. We order an appraisal. And the way the appraisal process works is we get 3 quotes from 3 approved appraisers on our list. And we figure out who's the best, who's the fastest, not always the cheapest, but sometimes you might need it done faster or whatever the circumstance is. Then during that process, while the appraisal is in motion, we're getting the remaining documents, maybe the ND documents, missing tax returns, missing information, bank statements, the normal process, to package up a loan. The whole process from start of an LOI to closing is probably realistically 35 to 45 days. Sometimes 60, depending on if there's some complications.
Absolutely. Thank you, Lee. So going back to Ben, let's talk about SBA and the fees that are associated with an SBA loan, please.
So there is a cost for bringing as little as 10% down. So the nice thing is, again, if your customer doesn't have a lot of liquidity, a lot of cash on hand, or they want to keep that cash for their business, the SBA, is a good conduit for that. It's a good form of financing. But what the SBA has is, since it is a government-backed loan, what they're doing effectively, or what the government's doing effectively, is the government saying, look, Wells Fargo, you can go out and you can provide the financing for this. So go ahead, underwrite the loan, go ahead, close the loan, go ahead, fund the loan. Just make sure you're abiding by our rules. But in doing so, the government's going to put a 75% guarantee behind a lot of these loans. So if a borrower is to default on a loan, let's say they borrowed 90%, the government's only covering 75% of that wash, and if the property goes into foreclosure, the government says, look, Wells Fargo, we'll give you 75% back on every dollar. Well, the downside is there's a shortfall there. So there is cash that needs to come out of somewhere. So what the government does is they say, look, rather than using your tax dollars to cover these situations where properties go into default and we've got to pay back the lender, we're going to put in what's called a guarantee fee. So it's a fee that's based on the size of the loan that the borrower is requesting. But traditionally, when you are talking to clients and the question comes up, hey, I've heard SBA fees are higher than traditional conventional loans. They typically will be, because again, the bank doesn't have discretion over how to calculate it. It's a calculation that the government puts forth based on the amount that's being borrowed. So again, there is that small opportunity cost of, yes, I can put less money down, but there will be a slightly higher fee. Now, those fees will typically be financed, so it shouldn't be an out-of-pocket, but it is something that the bank doesn't have any real control over.
Yes, ma'am.
When SBA puts a loan on a property for borrow, they cross-collateralize every other holding that the borrower has, every home, every other investment property. So if there is a foreclosure and a loss, and SBA takes over other properties, how does that wash?
It's a good question. And yeah, so the first thing is, the question was, if there are other assets that are cross-collateralized, what happens in a default situation? So the SBA doesn't necessarily take all of the assets of the individual. What the SBA says is they say, look, Wells Fargo, it's your responsibility to secure the loan to the extent possible. So again, going back to that $1 million purchase that we talked about, if the borrower puts 10% down and let's say it's a 5% shortfall, so we've got a $50,000 difference, that could be a $50,000 lien on one additional property or a $50,000 lien on cash. What would happen if they defaulted? We'd see how long they'd been in the loan. The bank's responsible for foreclosing on the property and then selling the property. The government then comes in and then they make the bank whole on what amount of shortfall there exists. So traditionally, we're in California, that we're a single action state. Usually the real estate itself covers that shortfall. If we do have to go back and look at other assets, let's say it is a house that's being used as cross-collateral, then we would potentially be looking at working on figuring out how to get the equity out of that to cover whatever the shortfall percentage was. But it doesn't necessarily mean we're putting a lien on every asset of the borrower. That would be highly unusual.
But it's a blanket, right? And therefore, you're going to make a decision. All those properties are going to be subject to scrutiny, until the SBA decides what to do. My question is that going to be a judicial or non-judicial foreclosure on the property that has to come up for the deficiency?
Typically, it's the bank that makes the determination on that, so every bank's going to work a little bit differently. The government doesn't come in to repay the lender until they figured out, what it can be sold for. So the bank can go out and remarket it or foreclose on it. But what will happen in most circumstances is, if we get back down to what personal assets could potentially be, have exposure, since it is personal recourse, which we talked about, the personal guarantee, the bank technically could go back until they've met that 100% threshold for collateral. But again, the bank will have to call on whether it's judicial or whether they do the foreclosure themselves. Yep.
Could you go back on the guarantee rate, like in your example of the $1 million property, and with 10% down, about how much would be the guarantee?
Yeah, good question. So again, we've talked about, there's two different programs that the SBA has. So one program's called the 504 loan. That's the 2 mortgage loan. On that structure, again, let's assume it's a $1 million purchase. Wells Fargo would do a $500,000 loan for the first deed of trust. The government charges Wells Fargo 50 basis points. So in that case, it would be $2,500, I think, is what it would come out to. The second deed of trust, the deed that the government's covering, that's the CDC, so they're covering that 40% threshold. They're going to charge 2.65% on that 40% of the loan amount, so 2.65% of $400,000, and then they charge a legal fee. Again, it's all going to be rolled into the financing, but it would be something that would be calculated, again, based on loan size. 7A is a tiered system, and the 7A program, again, that's the one where you've got one mortgage with the bank. So the way that one's calculated is it's based on the amount that the borrower is borrowing. So again, the government's going to guarantee 75% of that loan. So if we're using $1 million, let's say the borrower is borrowing $900,000, the government would back 75% of the $900,000, and then it's a fee that's calculated based on what amount they're borrowing. So it ranges anywhere from 2.5% up to 3.75%, depending upon dollar size. Just to keep it really high level, I mean, we'll be happy to help you calculate that fee because it will differ on every different loan, but that gives you at least a little sense of how it's calculated. Good question.
All right. So going back to Anna, let's talk about, I know you don't do anything below $1 million. Yours are above $1 million. Give us an example of like the ones you do and then what kind of rates they're looking at.
Yeah,
Please.
No, definitely. And we will look at something under $1 million, but it would only be on the Fannie Mae execution, which will be a little price, but drop bottom is definitely $750,000. On the Freddie Mac, their limit is $1 million minimum, so we can't do that. We can't offer that product on, if it falls below that. But typically, I mean, right now, the average loan that I'm seeing, because where the rates are, and it's attracting a lot of Chase borrowers that are existing with Chase, but the rate is much more aggressive. Again, this product just launched, and like all new products, they always come out really aggressive. I have a feeling eventually it'll stabilize, but right now they're definitely, the rates are very attractive. So that's why we keep seeing that. But the average loan is probably $1.5 million to $2 million. I do get some, really large loans. For us, large loans in the small loan world would be $5 million. But we're seeing $1 million, $1.5 million. Just like Lee, the same sort of requirements that we need to size the transaction, sort of the same similar process for the commercial. It's very similar. That letter of interest, once we both agree on the terms that we're going to be selling to the borrower. Timing is very similar, and the cost. I mean, we charge $4,500 up front and then about $2,500 at closing, so $7,000 all in. So it's not a bad overall cost for a multifamily deal in today's environment.
How long it takes for the loan to be completed from application to?
From beginning to end, I mean, the fastest is probably going to be 50 days, depending on
Best case scenario? Or?
Best case scenario. Yes. Worst case scenario, depending on you. I can tell you right now I have a handful of deals where I don't get due diligence. So appraisals typically come back depending how fast or when you need them, but average 3 weeks. Right now, in the multifamily world, because of what this product has done for lenders like myself, is everybody's overwhelmed. So the vendors are completely overwhelmed. They'll charge a little extra to do a 2-week turnaround time, but typically averages 3 weeks. So if you, the broker, can work with the client and get the due diligence package, by the time we order the appraisal, there's a 3-week window. So if you're diligent and the client that bring in the package, everything is able to run smoothly. But for some reason, it just sometimes doesn't work that way. And the summers are really hard because everybody's going on vacation, whether it's you, whether it's the borrower, or maybe the other sponsor, depending on who we're underwriting. So it's really hard to get everybody motivated in the summer unless it's a purchase. Purchase has, hard deadlines.
So there were two things. One, so is all your product Fannie Freddie?
All my product is Fannie Freddie, yes.
Okay, and that's why earlier you mentioned a 30-year fix, which isn't really common in multifamily. So you do a 30-year fix?
Yes.
And the rate, it's considerably higher, right?
A rate, depending on the leverage and where you are, a 30-30 could be as low as 490.
Okay.
Yeah, typically agency, from what I'm told, I don't know that banks, because I've always been in the agency world. Never really not very familiar with banking product, but on the agency side, anywhere from a 5-term to a 30-year term, and you can do a 2020. I've had people ask me, can you do a 2020? Not sure why, but that's what they wanted. So the shorter amortization, I mean, obviously that's a more conservative loan, so Fannie and Freddie are very open to that. Yes?
With interest-only loans, do they require a higher FICO score?
No. The way we qualify the sponsor, that's the way. If you're asking for a full-term IO, that's when the debt coverage ratio, instead of the standard 120, will increase to 140. If you say, and I want the full term to be IO, which we're selling that like crazy right now. And especially all the borrowers are trying to capture these rates today, put more money in their pocket, and be able to take that cash and go buy other properties because it's interest only. So it's just a different time right now with the rates so low.
I got a question relating to your interest-only loans. Now, what's the typical borrower profile? If you're going to have a 30-year interest-only, upfront 10 years or something like that, are they a fix and flip apartment person, or is that the main customer?
Well, it's either a 5, 7, or 10. It's not like 30 years of full interest only.
Right,
No,
right.
So you're asking what kind? Well, typically,
Because nothing
yeah.
gets amortized during that interest-only
That's
period,
correct.
so-
That's correct. They're taking most of that cash, and a lot of people are reinvesting and buying. Right now, the acquisitions activity is extremely high. And it's because a lot of borrowers, they have deep pockets. So money is not necessarily a problem or an option. It's just that they're taking that cash flow because the rate is so low. But also remember, the prepayment structure on those loans, it's depending on which one you get. For example, I'll just give you the 5-year standard 54321, and then it rolls into adjustable, which is 1%, or you can buy for 10 basis points more 32111. So the borrowers are like, let me have interest only, let me put a couple more years or full term, but I know that I'm going to pay it off and refinance it. But let me capture as much cash flow and put it in my pocket today so that I can take that money, because as you know, most investors don't really use their own cash. They're using cash from other properties, they're syndicating, they're raising money, they're doing other things. That's what investors do. Mom and pops, a little different. Mom and pops, I see that if they're not typical investors, what they do is they're like, I want a 30-year, I want to leave it alone, I never want to refinance it again. So I have those clients as well, they take the 30, not necessarily no interest only, just 30, and I never want to touch it because it's for my children. Okay, go ahead.
I understand your program has some exclusions as far as the geographical areas and so on. Can you expand on this? What areas are excluded and population-wise, whatever it is?
Are you making that statement because of the single family? Because
No,
okay.
multifamily.
Yeah, no, we don't have.
Population, or there's no population restrictions?
No.
Or type of apartments?
No.
The age of apartments?
No. No, and I'll tell you why. One agency can't redline, okay? I just did a deal, borderline Compton, okay? Or some people consider Inglewood really a tough area. You know, some lenders do. They don't redline, and if the deal makes sense, and I always say neat and clean. This product type is neat and clean. Is it Class A? No, it's not. It's neat and clean, but both Fannie and Freddie are out there with the mission, affordability. So in this product that they're selling in this type of program, they want the affordable units. And what are affordable units? Section 8, not affordable meaning HUD, but meaning Section 8 vouchers. They love that. That gives them a certain affordability that they need as being agency, which is government. So they don't redline, and we are nationwide. Now, are we going to, I'll give you an example. Are we going to lend to a borrower that lives here, wants to buy in Arkansas, never been there? His financial wherewithal is average? Probably not. Now, are we going to lend to a guy that lives here, has other stuff there, strong financials? Yes, we will. So it's all relative, but there is no set sort of parameters. And because with Freddie Mac it is nationwide, also Fannie created a list called pre-review markets. For example, if you're in Missouri, they gave us lenders certain delegation. If we exceed that delegation on leverage or debt cover, we have to ask their permission.
So the refi is a cash out refi? Do you allow cash out unlimited, or?
That's all we do.
It's how good?
Yeah, cash out, the maximum is 75.
So,
Leverage.
So if you have a loan to value 50%, you can get the maximum out?
Yep.
You can do
I'm
that.
cashing borrowers out up
So
to
you
$2
compete
million
with the
or
CBS
more.
market?
I'm sorry?
You compete with the conduit market.
Oh, yeah.
If you can do that, that's a conduit market.
Yeah.
You can unlimited.
Yeah. Now, and again, everything, at least for me, I'm very passionate about what I do, and I love what I do on the multifamily, and I've done it for a long time, because it's not like a checkbox. You look at every deal, yes, you're following the similar process, but every deal is a little bit different. Now, am I going to cash out $2 million to this borrower that just bought the property and he bought the property for $1 million, and he's asking for a $3 million loan, and he put $100,000? It doesn't make sense, right? But if I'm going to do that, maybe there's a different story that he bought it on foreclosure, and there was 100% vacancy, and now so it depends on the story. With multifamily, there's always a story. So you really have to understand the story, sell it to the lender, and lenders do that. So now, again, in the single family, you're looking at just the warm bodies, right, to repay the loan. But in the multifamily, you're looking at both. You're looking at the individual, the deep pockets, who's making decisions and certain ownership percentages. But you're also looking at the property financial wherewithal to see how it's going to repay the loan. But stories is what lenders look for. So when you're out there, just remember, figure out what your client needs. And if there's a story, because right now every deal that I'm getting has credit issues. So the brokers already know, and they're well trained. Get me the story. Tell me why he paid late, or tell me why his partner almost filed for bankruptcy and it's affecting him. And give me the story, give me the breakdown, and we'll filter it through upfront. Because multifamily lenders, we find everything, which is not a bad thing. It's a good thing. But full disclosure up front, we can work through here, basically. Yes.
Can you educate me as to what AIO is?
A.
You said that acronym a while ago, AIO.
I think you said IO.
Yeah, IO, interest. It's interest only, sorry. Yeah.
All right. So moving on to Lee. Lee, most of the agents here, they're used to closing in 30 days. In your product, kind of tell us about how long it would take to do yours.
For a purchase transaction?
Yes.
You're going to want to allow about 60 days in your escrow. Give yourself a couple weeks of wiggle room. Don't go under have to close in 30 days and force it down the lender's throat to get the appraisal done on a rush. It doesn't always go that fast. Sometimes the appraiser might need a few weeks to do his thing. So 45 days is a good sweet spot, but I recommend you have a 60-day escrow period. And then, because usually about 35 to 45 days in, it's approval time. And at that point, you have an approval in writing, and maybe that can calm down a seller, buy more time if you against the rush and all that.
Excellent. And then, Ben, how about yours for your product? Can we close in 30?
It would be tough. So with the SBA, everything has, again, regulations, right? So the bank has to go out and collect certain information in order to be in compliance with the government. I would kind of follow Lee's timelines. I'd say at a minimum you want to try and give yourself, if possible, a 60-a-day escrow. Maybe build in a 45-day contingency period to get your loan approved, get your appraisal done, get your environmental. I'd say 60 is a good spot for us. Have we done them in 30? Yes, but what it's going to take from your borrower is it's going to be a circumstance where they've got to come to the table with virtually everything up front, all the financial documentation, articles of incorporation, bylaws, new entity formed, and then they have to go be comfortable going out and spending money to get an appraisal and an environmental going from day one. Some of your clients aren't going to be comfortable with that. Some of them are going to say, look, I'd prefer to wait to spend that money until I know I've been approved by the bank. If that's your customer's temperature, then I think we have to try and set the expectation. Work towards 60 days. If we can close sooner, we absolutely will, because I get paid based on when the loan closes. You guys get paid based on when the loan closes, and the borrower wants to get in that property. I'd say the only thing that's going to extend those, for longer time frames, let's say you've got a client that found the perfect property, but that perfect property is going to take some work. They need to do some tenant improvements. They want some construction financing. Anytime you're getting into circumstances where we have to include construction, then we start dealing with entitlements, permits, contracts, engineered plans. If you start getting into circumstances where you've got a customer that likes a property but needs to convert it and needs to rely on the bank to finance it, then I think we have to start even broadening that expectation further. Maybe then you're starting to talk about 60 to 90 days to close escrow because it's going to take time to get through the city. But I mean, I'd say for the most part, 60 days is typically a good time frame.
George?
If you have that property that the buyer wants to finance the improvements, the rehab of the property, what level of entitlements do you need to approve the loan for that construction?
Good question, George. So I think it's going to depend on the scope of the project. If it's a tear down, they're buying a property, they're going to tear it down and they're going to go ground up. It's going to be a circumstance where we're going to want to see that the city has stamped the plans at a minimum. Permits would be better, but we'd want at a minimum to ensure that the city has stamped. And here's the reason we do this. So we're talking about high leverage financing. So we're trying to get your client into that property with, again, 10% of total project costs. So let's say it's $1 million purchase, but let's say they want to put $200,000 in improvements into it. They're still only putting in 10% of the $1 million too, so $120,000. The challenge becomes if we go too fast. So let's say you've got a client that is hell-bent on trying to close early. we still have to have an appraisal done not only for the property in its current condition, so making sure that they're buying that $1 million property that it will appraise for $1 million, but we also have to do what's called an as proposed or as completed appraisal, meaning that if they want to borrow money to build out that space, well, we need to ensure that that property is going to appraise for what the finished product's going to be. So if we try and act too aggressively, the appraiser may not have enough information to make that call, to make that determination on value. And the other more critical piece, I think, for your clients would be if we go too fast, and let's say we do close early, but maybe they've only gone to plan check once, and then the city comes back after we've closed escrow and they said, whoa, let's put the brakes on. All these changes that you've said you wanted to complete, we're going to do changes to those. So we're going to need you to put additional X, Y, Z into place. Well, if we haven't provided financing for that, who bears the burden of that out of pocket? It's your customer, right? So if you push too aggressively in those circumstances and you do try to push on getting something closed quickly on a very complex construction project, it could be a circumstance where your client winds up having to come out of pocket instead of 10%. Maybe with all those change orders or maybe with those additional cost overruns. Maybe they're then out of pocket 20 or 25% because we didn't take the necessary steps to ensure that we were protecting them. So I'd say it'll be dependent upon the needs of the client and the construction that's in place, but I always hesitate to try and tell someone close quickly when they know they've got issues that are out of their control because the city has to sign off and get things permitted. Not necessarily. Again, I think it'll depend on what's being done. If it's a huge electrical overhaul because the space wasn't set up for their type of property usage, probably. If it's simple plumbing issues or roofing, probably not. I think it's just understanding the story. Like Anna said, I think every deal has a story. Understanding what's going to be needed and then making the determination from there, as early as we can in the process. Do we think this is something that will require permits before we close, or is this something we can go in with a little bit less intrusive oversight?
Question here?
Could we get each of these people to give us their view on appraisal guidelines with special emphasis on what properties you can use or we could use in showing the value of a building that we're interested in financing?
CRMLS. Taking those courses through CRMLS, who I know does courses, right, for the association. Absolutely. I would definitely, because you want to understand the value. I mean, you can underwrite the deal, apply a cap rate and get it, take your NOI and apply a cap rate, but to know, well, what cap rate do I use? Well, how do I know on the cost? Because Lee looks at square footage, we look at per unit. Everything is per unit in the multifamily world. So you want to understand, well, is the borrower's estimated value, is that accurate in that market? I mean, I don't know. I don't know if anybody knows right now, but cap rates are ridiculously low. I call them stupid low because, you're looking at 4%, even in LA areas. It's extremely low. Santa Monica, Westwood, all those were always been low, but now cap rates are extremely low. So I would definitely take that course with CRMLS, run some comps that I know you have access to determine. And basically, you're just doing a comparison on, when it was built, the number of units, and location. Because what appraisers do, what they gather is sales comps. To determine their value, it's based on actual sales, not something in escrow, but it has to be based on sales. So I would do a radius, because I believe I've seen CRMLS, and you can even do a radius circle. It's a great resource to have. You can do a circle and pull out those sales comps and then just filter through the date of construction, the size, location, and try to determine on a value per unit. And just what I usually look is an average. Okay, well, these sold at these cap rates, and I'll take an average or align it with the most that is more similar to mine. Like if you want to do a quick analysis.
How far back do you go?
Most recent, 6 months to a year. Obviously, if you go to a market, if you're nationwide, you might not have comps. So it is what you get. So you might have to go out 2-3 years, depending if it's a tertiary. Are you going to Hemet? How much sales are in Hemet? I don't know. But if you're out here, I can tell you out here activity is pretty heavy. So you're going to find a lot of comps out here.
Lee?
Same thing. You want to get comps, apples to apples, oranges to oranges. Appraisers use a service called CoStar or Reese, which are very expensive, and they put in parameters, age ranges, number of unit ranges, They do a radius, and everything within 1 mile, 3 miles, 5 miles, they'll pull up comps. And what you want is recent comps in this market. A comp that closed, say, November 2014, well, that's a whole different market. And what the appraisers will do, they have to look at that. That's the only thing there is to look at. But they got to make adjustments with the current market conditions. The cap rates are lower. Things have changed since then. That comp that closed in November 2014, that was probably a deal that was in escrow 2 or 3 months. Then it was probably on the market for 3 or 4 months. And what was sold when that deal started was the 2013 comps. So your hard work today is getting recent comps. It's digging, calling brokers to sell the most, and having the luxury of having the database, CoStar, Reese, or the MLS, and all that.
Absolutely. Ben?
I think this is such a great question and such an important question for everyone in here to kind of focus on. One of the biggest reasons I lose a deal is because the property doesn't appraise, and we have control over that. As the lender, I don't have communication with the appraiser because we're not allowed to. So what we do is on every deal, when we get to the point where your client is ready to order the appraisal, and both Lee and Anna have already touched on it, I rely on you to provide the appraiser with comps, because at some point that appraiser is going to have access to the property. And who's going to give them access? You guys will, or the listing agent if you're not the listing agent. At that point in time, when that appraiser is visiting the property, that's the ideal time to say, hey, I've done some research for you. Here's some recent properties that have been sold in this area that I feel are really good representations of this property. It gives you the ability to justify why that property is listed at the price it is. I recommend in every circumstance you guys, at the time of the appraisal, hand those comps to the appraiser, saying, here's the data you should be using. And then at a minimum, if they don't come in, we can go back and we can create the argument. We can say, look, I provided this appraiser with comps. He maybe only used 1 of the 5 comps I provided him. Here's why I feel that you missed the mark on this appraisal. We should be looking at X, Y, Z because they're better representations of this property type. I mean, I think it's huge, and I recommend it in every circumstance that you or the listing agent, or vice versa, if you're representing the seller, if the borrower's agent, have some data available so that we don't get into a circumstance where the appraisal does come in low when we could have prevented it.
Excellent. So I wanted to talk about something. So you go and list the property. You talk to the seller. You come up with a price, right? So you came and put a price on it. You get it into escrow. You put it out there. You get it into escrow. And I heard this 2 weeks ago, and I couldn't believe it. I had to talk to the agent. He said, they're going to come and appraise the property. I said, so he was in my office. I said, what are you doing here? He says, oh, it's none of my business. It's the buyer and their agent out there with the appraiser. Don't ever do that. Don't ever do that. You own that product. You price it at $1 million. Let's just keep it easy. They go out there, they don't have information, and the appraisal comes back at $850. I don't know how you're going to look your seller in the eye and explain what just happened. I don't know how you're going to, this deal is going to break out, it's going to fall apart. Guess what? From now on, everybody that calls you, have you had an appraisal on this before? What's your duty? You got to tell them. There is another appraisal at $850. Well, you guys at $1 million then. So when the appraisal comes, you own the product. Get in your car, get all your comps, meet them, give it to them, give them all your information. Tell them this is what you do for a living. Own the product. Don't worry about the residentials that they price a property and it goes $50,000 over and all that. Forget that stuff. You got to own this product. So it really falls on us to do this. You can't count on them to do all this stuff. They do it, their job is on the loan side, but we priced it. Remember that. We're controlling that. So just a little, 2 cents from me. I'm done with my questions. If the floor is open, if you guys have any questions, just let me know by all means. And then I want to make sure you guys get their information because you are going to run into SBA, you're going to run into apartments, and you're going to run into lease product, with the all kind of, office buildings and everything. But questions? Anybody? Oh, you guys are easy. Yes, George.
Maybe just kind of a snapshot for the upfront cost to get the loan process going. Well, what does the buyer need to write a check to you for appraisal, environmental loan, or any loan processing, whatever, just to get the loan?
I'll start out here in your backyard, $4,500 check. $4,500.
Lee?
Good question. Range from 3,500 to 5,500.
And I'd say I'm going to be probably somewhere in that same ballpark. Again, we'll probably give you the opportunity to order your own environmental, so it's not an out-of-pocket necessarily to the bank. But on the commercial appraisals, 2,500 to 5,000, somewhere in that range. Probably get you in that ballpark. About 2,500 to 5,000 is probably a good range, depending upon if there's construction.
Question? Yes, ma'am.
I know you spoke about environmental for SBA. On the other two, do you usually require environmentals or no?
Yes, on our side, on the agency side, yes, we require an appraisal, which is a typical 8-page appraisal. I don't know if it's 71A or what it's called, but it's the 8-page appraisal, which is what we require. And also with Fannie Mae, it's a engineering database. What they do is not a full phase one, which is more intrusive, but it's more of a desktop phase one. So, for example, they enter the address into a system, and if it actually alerts them that something did occur, then that's when we do more extensive work. But other than that, it's just more of a database environmental that we attach. On the Freddie Mac side, we do have an engineer go out to the property and provide sort of a schedule, and they also just attach the desktop environmental report. So.
What's your issues with tuck under parking right now?
Tuck under parking, on both the agency, if it's built prior to 1980 with tuck under, both Fannie or Freddie, it does require a seismic report, which is a PML report, PML/seismic. So what happens with, out here where we live, most of it has tuck under, correct? And most of it is built prior to 1980. So what we do, we size a deal. Obviously, if you don't send me pictures, I definitely Google it. And if there is tuck under, I ask you to, if the numbers work and everybody's happy, we need to order the PML. So I give you sort of a quote sheet that says, based on everything you've given me, we can meet. Just call this engineer. Usually I refer everybody to Steve Canty with GRS. He's here locally. And have the PML ordered, which is $900 from the borrower. The borrower hires the engineering firm to run the PML because you'll know within a week whether you have an agency loan or not. There's no point of starting the process, kicking it into underwriting, because if it exceeds 20%, either A, you retrofit, which most of us don't. However, you'd be surprised how many borrowers are retrofitting now since LA came out with the new 20% of the seismic report activity. In terms of the seismic, what the engineer determined the probable maximum loss to be or the estimated loss. Freddie Mac will look at the estimated loss, SEL. So it just kind of varies, but we'll know that up front. I'll give you a quote sheet. Go ahead and have your borrower or broker, some brokers, depending on the relationship with their clients, pay for it. They hire Steve Canty. He goes out. They produce a report. And if it's under 20%, green light. We just move forward, start the other process. If it's over 20%, I have several deals in underwriting where the borrower is going to retrofit. And I don't know if you've heard the news, but LA, everybody's coming out with these new, eventually, it's not a law yet, but everybody's talking about retrofitting. So a lot of borrowers are very open to it now because they, all the seismic activity that we do have. So they're very open to it. So I am seeing a lot of retrofit being done by clients.
Can you give credit to escrow to do the work later, or you have to do it before the building?
Very good question. Depending. I have buildings that have, what is it called, crawl space, and all it is bolting. We're comfortable doing that post-closing. So they have to do bolting to reduce the risk, and we're comfortable doing a holdback and doing it post-closing. Now, if it's something that's going to affect the tuck under and it's going to affect my loan, which means occupancy, tenants are going to start asking for rent credits, so it's going to start affecting NOI, we probably will not because that affects my loan. So it just depends on the extent. So once the PML is over 20, the second step is let's get a retrofit letter and bid, and let's see what the work entails. If it's minor and it's non-intrusive and it's not going to affect, monetarily for the loan because people are going to start asking or occupancy or things like that, then yes, most likely yes post-closing. But if not, we'll want it done before. So it just depends.
Anyone else? Questions? Yes, ma'am.
I want phone numbers.
Okay.
I brought cards.
Can we just get them verbally right now?
Sure.
And I'm sure they'll have cards as well, but by all means.
Sure. Yeah, I have cards, but yeah, I'll put a card there for you.
Okay. All right. Yes, George.
With each of the product, the loan types, how about the unreinforced masonry loans? Is that a product?
Want me to start?
Sure.
So the nice thing about the SBA is there are no real property condition assessments per se that are required. It becomes a discretion of the lender. Wells Fargo is comfortable with that property type. I'd say if we got to a threshold where that property type was extremely large and maybe in excess of $5 million for the purchase, then maybe we would want some type of PCA, property condition, just to make sure we'd be comfortable with it. But from that perspective, just simply property type alone, that's eligible for SBA.
Excellent. Lee?
That would be a case by case. You might have a mixed use with some retail, commercial below, but if there's apartments above, that will not work. Could be a single-story commercial that's not reinforced, and it might not be that big a deal. But lenders are going to look at it, because it should be reinforced.
Anna?
For me, it's not an eligible property. However, you order a PML and it passes that, then we're fine. Because most unreinforced masonry actually is somewhat reinforced because of the city requirements, but it needs to pass that threshold. So just the way sometimes you can tell when they put stucco over it, they have those bolts outside the walls. So just look out for that, because once we get the engineer there, he'll discover that. So we do need to run a PML if it is that property type.
Well, yes, ma'am.
Can anyone do a church building by any chance?
Nobody wants to foreclose on that.
I'm like, not me.
SBA only does for-profit companies, so typically churches fall into the nonprofit, but Wells Fargo does finance churches. It's just on a case-by-case basis.
There's lenders for that, and I have a referral for you if you want. I do, yeah.
More questions? I'm going to let them go. No questions? All right. I appreciate it. Thank you for the panel for coming. Thanks for your time. Make sure you come up and get their cards and information, and you will use it. Thanks again, everyone. Appreciate it.